Good Monday morning. It's 9 a.m. in Hong Kong and Beijing. Welcome to Bloomberg Markets China Open. I'm David Ingles with Yvonne.
Our top stories this morning. Asian stocks brace for a flood of economic data this week, including China's PMI numbers, activity gauges, and the Fed's preferred measure of inflation. China's stocks' stunning reversal from world's worst to best performers is stoking optimism that the rally will continue if policies remain favorable. And BYD debuts its most expensive car, a high-performance, fully electric supercar, pitted against gas-guzzling Ferraris and Lamborghinis. And you take a look at this market, I guess you do need a bit of a supercar. Yeah. And what we've been seeing here, as we talk about, right, how do we go from the worst to one of the best equity markets this month? That certainly is one we're watching out for. Is there something more to this? Or is it just sort of the short covering that we all been talking about for a long, long time now?
That's a good point, because we've certainly seen, a rally on price of this sort, right? But that being said, we haven't really seen the CSI 300 up, 10 days now?
Yeah, 9.
Could get 9. Yeah. Could get day 10 today, so we'll see what happens with that. A50 futures coming online over in Singapore, and it's looking like we might get some weakness, although that doesn't mean, of course, we end the day this way. Nikkei 225 is continuing that massive rally that we've seen certainly last week. So 40,000 perhaps now in the cards here these next, few days and weeks. As far as Australia is concerned, we're flat right now. We're within about 0.5% from retaking that all-time high that we hit earlier this month there. Flip the boards. One market that is also in focus is Korea. We're down after the unveiling of some of the details on this Value Up program. More on that in a moment. 3 markets coming online. FX markets doing this. Finally, the dollar weakened last week, following, I think it was 7. Maybe 8 weeks. RBNZ's on deck this week. Could hike, although consensus is they'll hold. Although you are getting a few forecasters coming out and saying that they might actually move on rates this week up. That is, to be more specific there. Bond markets doing this. Flurry of Fed speakers, flurry of economic data coming out. We're slightly just below the year-to-date highs in the Treasury curve right now. 240 on China 10-year yield. And commodity markets doing this. Bottom of your screen's coming up. U.S. crude, Brent, and all things in between were mostly weaker across the commodity curve right today. There we go.
We'll see if we round those numbers, right? A 10th straight day of gains for the CSI 300 will certainly mark something. We've already in the longest winning streak since 2018. We're past about 10% from the lows that we saw back in February. In terms of this agenda here today, that certainly is the equity market very much in focus. Let's not forget that junk bond rally too, right? 11 straight weeks, Dave, that we've seen gains there. There's an anti-graft body work report, of course, we're going to look into in terms of details there. Li Auto earnings coming up. Hong Kong tourism stocks. There are, of course, as we count down to that budget, what sort of measures we could see to kind of bring back more tourists to the city. There has been some reports from SCMP that there could be some meeting in Hong Kong with business groups with Mr. Xia himself. So certainly that could be one to watch, of course, as we count down to that budget. So certainly a lot hanging on the investors' minds this week. Yeah, and
the meeting actually today between Xia Baolong, of course, and the business groups, including I think I looked at the reports, including the AmCham, might actually give you an indication maybe it's embracing maybe a private sector. We'll see what happens with that as well. Now on the China rally story, and certainly more on the earnings front. About 60 minutes back, we had Morgan Stanley on the show as we talked to Jonathan Garner, Chief Asia and EM Strategist at Morgan Stanley, and he actually told us why the bank is still not bullish on this Chinese equity market. Have a look.
It's just a sort of a negative fundamental. So there is a reason why this bear market has been going on in China for so long. And until that's addressed, which we think requires consumer to come to the fore, basically through fiscal stimulus that targets the consumer, it's unlikely that the earnings profile for China will turn around.
Let's get a preview now on what to expect of this open. Let's bring in our Asia equities reporter, Charlotte Yang. Charlotte, you've been talking to a lot of money managers out there. What do they make of this rally? Is it something that's meaningful in their eyes? Or Are we just talking about a bear market bounce or whatever?
Yeah, I think to start with, sentiment has really recovered for the Chinese equity market. If you remember last month, we're still talking about so many pressure points, from blow up in structured products to, margin costs. I think after, Chinese authorities almost daily policy measures to support the market, right now investors do feel like a bit more confident about this market. But what we've been hearing from many managers in Europe as well as in the US is that they feel like the rebound we saw last week is not a widely participated one, meaning that still a lot of the long-term, fund managers are still standing on the sideline. But with that said, given the valuation level is so attractive and also the light positioning as well as the expectation that we'll continue to see more support from the authorities, they feel like we could see some tactical upside from current levels for the market. But, a meaningful turnaround, we definitely will need more improvement on the economy side, not just market-wise.
Yeah, and, we get some indicators on the economy this week, and how important will those metrics be to this rally? Yeah,
I think the activity data, manufacturing activity data we get on Friday will be very important for the assessment on the economy side, and also a lot of earnings. Investors are paying close attention to whether that's electric vehicle maker Li Auto's earnings up to market today, or Baidu and NetEase that will come up also during this week. I think their specific results will give a lot of sense of how, for example, like competition concerns are playing out for the specific sectors and how profitability are looking for those companies. And also, I think the key thing to watch, everybody knows, is next week for the National People's Congress for the policy signal.
How big of a catalyst is that going to be, that MPC?
Some people are saying that it's more of like a make it or break it moment for some, because, on the state support side for market-wise, you do have national team, some people believe, are continuing buying, but the biggest thing still is going to be property and also economic growth target. So I think if policy signals disappoint on that front, a lot of people might turn back to be more cautious again.
Charlotte, thank you so much. Our Asia equities reporter looking ahead to the open here. Shanghai Comp has retaken 3,000. We could get a day 10 on the CSI 300. You can read all about this, by the way. The quant quake in today's big take. We didn't mean that on purpose. There we go. You can find that on your terminal and also on Bloomberg.com.
All right, still ahead. We heard from Morgan Stanley. We're here from JP Morgan now. Wendy Liu saying investors should start leaning more towards risk on trades when it comes to this equity market in China. She's going to be joining us at the bottom of this hour. We're also cutting down the open of trade in Shanghai, Shenzhen, and Hong Kong. Certainly watching to see if Monday can lead to more extension of gains here. 850 futures, though, slightly on the negative side here. We're down about 0.4% on a gloomy morning here in Hong Kong. Happy Monday. It's a busy week when it comes to eco, when it comes to central banks. Obviously, the Fed and the commentary we're going to get this week is certainly quite a lot. And of course, you got to talk about the activity data out of China. Certainly one to watch in terms of the PMI numbers. That's the key one. Japan CPI expected to see core inflation undershooting the 2% target for the first time since March 2020. Does that complicate the equation for the Bank of Japan? That's certainly one to watch here as well. We have also retail sales of Japan from India GDP, Aussie retail sale, RBNZ decision. There's some out there that saying they could actually hike as well. That Hong Kong budget, a key one here for any sort of policies when it comes to property and how to bring back tourism to the city as well, Dave. And then, of course, a whole list of speakers from the Fed.
Oh, a ton, yes. And so those conversations are sprinkled over also quite a busy week as far as economic data is concerned. And certainly, is there still room to push back, I guess, as far as market pricing around Fed easing is concerned? Current pricing, in case you're curious, we're looking at least 2 cuts by September. Is that still too much, or is that Goldilocks? Pretty much at this point in time. Dollar, as you can see, flat after, 7 weeks of gains. We did clock in a weekly decline on the Bloomberg Dollar Index. There we go.
All right, let's bring in Ben Emmons, Senior Portfolio Manager and Head of FI Macro Strategy at New Edge Wealth. Ben, it's always great to talk to you. I mean, obviously, all the focus last week was on the equity market, just given what we saw with NVIDIA. And it's really ignoring what the bond market seems to be, pricing in right now when it comes to the Fed. I just got to wonder, are you still encouraged by this rally that you can continue to chase these gains? Or is there reason to be a bit more worried now?
Hi, Yvonne, David. Yeah, great to be back. It is a momentum market because what happened with the NVIDIA earnings was just showing there's so much more than just about that company in itself, right? I mean, it really looks like that AI is more and more widely adopted in the United States and lots of activity happening. So the market caught a bit on that, not just because of NVIDIA, but because it shows that it can impact the broader economy. So the momentum now showing up in stocks like Walmart or Home Depot or even in financials like American Express that all are sort of linked to this, sort of like effect from AI on the economy. So we're in a position here to say, like, let's go with this momentum a bit, because it's not anymore about that NVIDIA looks really overstretched, and if then rates were to go up again, then we're getting some sort of a major correction. It seems that actually the market is in a sort of a cyclical recovery, as we say. So I think we should stay with this momentum. I don't think there will be much derailment of it, no matter what the Fed says this week or what the numbers say this week as well.
Yeah, Ben, I guess just to follow up on that, how long do you think at least the U.S. equity market, to be more specific, can remain, I guess, somewhat divorced to Fed speak? In other words, can the market rally whatever the Fed says over the short term?
I think in the short term it can, David, but you're right. Like, it won't be as long divorce as you think, because I'm of the opinion, though, that the Fed very much matters. But, because last week, clearly there was a rollback of expectations of these rate cuts, right? As Waller, for example, really strongly came out and said, like, we probably can hold off here for some time before we actually, have to do anything. But yet the market is so enamored with this effect of NVIDIA and AI on what's going on in the U.S. economy that you have to temporarily divorce. But let's keep an eye on the Fed. There's a lot this week in terms of speakers. Clearly, the economy has some momentum. So if you're getting to the point where the Fed sounds more hawkish than what they are currently, then I think it will impact broader markets.
Right. And, Ben, pricing on the Fed has gone from 6 to 3. That's half in, 6 weeks? And I'm just looking at the tail risk here. Should we be surprised if the Fed does not cut rates this year?
Yeah, I'm of the view, David, that maybe be the case, because if it really is an economy that can hold up in the way it does, like as in, I looked at data this over the weekend, right? That was in that note that, the manufacturing is really expanding. And I think the ISM data this week will probably show that there's more strength. So there's all this productivity underneath. Then the Fed is actually in an economy where probably inflation is sort of staying where it is, with the strong services side of the economy against production picking up. So you actually don't have to cut rates. If anything, it probably is an economy where inflationary pressures may resurface to some extent, but it keeps the Fed funds rate just tight enough, right? So I think the Fed is in a position not to do anything, at least well into the summer.
So, Ben, you talk about the stall in disinflation that we're seeing in the U.S. Do you think this is more just a pause, or is it something more threatening?
It's something to watch, obviously, because I think that we got so enthusiastic about the disinflation, particularly in the fall of last year when it started to show. It wasn't just the good side of the economy, it was also rents that started finally soften. Unfortunately, it's just reversing back up, right? And I think it's an issue that we're dealing with in the U.S. economy in terms of the shortage of housing, and that rents are still very sticky. And it's not so simple for the Fed just to get that also cooled off. In other words, you need to keep rates higher here for longer, right, rather than cutting them. So it is a risk that the stalling of disinflation, if that becomes more pronounced, that you're getting a different view in the markets developing of we may get some more higher inflationary pressure. So it's a warning sign. I would say it's one number, as the Fed says. We have to watch the next numbers. The PCE data, obviously, on Friday will be really key. I think that data, too, will show that there's probably stickiness of rents in the PCE.
Does let's say we get a nasty number in the PCE print, how much upside do you see short term, if any, on the Treasury curve? I think we're slightly below year-to-date highs across the curve at this point.
So it was interesting to see, David, last week that the 10-year broke just above the 100-day moving average at 4.35. Now, why does this matter? Right? We have a lot of very specific positioning here in the U.S. in terms of big short positioning in the short end of the curve and a lot of long positioning in the long end of the curve, and a lot of things are all over the place. And so if you get a break of the 10-year and the technical level, and it sort of opens up the door for, say 4.5 or 4.6, that the PCE can be really a trigger for that. We have gotten hotter CPI and PPI data that feeds directly into PCE. So the estimates already there that it could be hotter. I think that Anna Wong, the chief economist of Bloomberg, I think she estimates 0.7 on the month, which is one of the highest estimates out there. That could indeed put pressure on the treasury market. So it's not it's not something we can ignore in terms of the risk of the PC being a bit stronger than expected.
Ben, just on China here, so we're up 15%, depending on which index you look at from the bottom here. But certainly this equity market's been the best performer globally over the last several weeks or so. So, the conversations certainly near Beijing and here in Hong Kong might be different from what you guys are having over there stateside in the U.S. Just give us a sense of foreign flavor for this equity market. Are you guys buying into this, or is it still largely a sort of local story, this part of the world?
So we're definitely looking at China, David, because Alibaba is actually a really good company and there's a lot of good fundamentals. Is now really undervalued as an example. The broader market itself finally got some footing as the Chinese government continues to stimulate. I was just looking at liquidity injection by the PBOC that continues to start ramping up again, right? So there's support for the market. Obviously, that emphasis on the short sale ban at the open and the close. That's of course that's some pressure on the upward pressure on the market too. And I noted that the short interest in ETFs traded here in the US, or say KWEB or the FXI ETF, that short interest is at the record high. So there's definitely fuel here for the Chinese market to see some recovery. Again, all about the pandemic, right? And how ultimately with more stimulus, finally also China comes online. So it is, I think, an opportunity given that it has really lagged other markets. And I think it's gotten noticed. So I think it's an opportunity, David, to engage with the Chinese stocks.
Mr. Emmons, have a good week ahead. Thank you for your time. As always, Ben Emmons there, Senior PM, Head of FI and Macro Strategy at New Edge Wealth. Right, the midpoint of the day is out, 3 minutes in, 710.80, estimates near 720. The approach to the open, 7/10 to 1%. We're looking at weakness, as you can see. 11 minutes to the opening bell. Happy Monday. Hope you're all well rested. This is Bloomberg.
All right, Hang Seng pre-market is up, and we are just slightly to the downside, about a fifth of 1% here this morning. Of course, we have to talk about whether we will see a 10th. Lucky 10, maybe, when it comes to CSI 300, Shanghai Composite. We talk about that 3,000 psychological level as well. CGBs are not going anywhere, despite what we've been seeing in this equity market. 720 for your offshore rate here this morning as well. A Bloomberg scoop that we have to tell you about that just happened in the last couple of minutes or so. We've learned that Jack Ma's Ant Group has outbid Citadel for Credit Suisse's investment bank venture in China. Let's get more now from Lulu Chen, who leads our Asia investing team here at Bloomberg. Lulu, what more do we know? How surprised of a move is this?
Pretty surprising. People familiar have told Bloomberg News that Ant Group outbid Citadel Securities for the JV that Credit Suisse was previously running, the investment banking JV. It puts UBS in a bit of a dilemma because Citadel Securities was the only global player that bid for the unit, but Ant is offering a higher price. It's possible that Founder Securities, which is the JV partner, will reject Citadel Securities' offer and delay the process even further. Right now, I think they have to choose.
Yeah, and just in case that bang that you heard was Ken Griffin, I'm kidding, in the background. So give us a timeline. Does this transaction need to close anytime soon, for example? And to your point, right, UBS is in a sort of pickle because there is quite a wide gap between the bid from Ant and the likely bid that might actually come through regulatory-wise if it's Citadel?
Yeah, one of the key tensions here is regulatory scrutiny. We've been told that regulators are preferring to have a foreign buyer for this unit because when the license was awarded to Credit Suisse, it was intended to attract more global companies to China's financial markets. Hence, the scale is leaning towards Citadel Securities, and also had ambitions to build a securities business, but that was halted when the regulatory clampdowns happened. The pricing on the unit, previously Credit Suisse wanted to buy out its local partner and it valued at $2.3 billion, 2.3 billion yuan. But right now, Citadel Securities is only offering a bid of 1.5 to 2 billion yuan, we've been told.
All right, there we go. We'll keep on top of this story. Bloomberg Scoop, check that out on your terminals and also on the website. Lulu Chen, who leads our Asia investing team. Right, some other corporate stories that we're tracking this Monday. Ferrari, look out, BYD out with its bet, unveiling its most expensive EV supercar on Sunday, the fully electric Yangwang U9. Actually costs over $233,000 and will initially be for the China market. Now, BYD says the supercar can hit 100 kilometers per hour in about 2 seconds and reach a top speed of 309. The vehicle aims to rival gas-guzzling options offered by, as we mentioned, Ferrari and also Lamborghini. Okay, Berkshire Hathaway says its cash balance jumped to a record $167 billion. That's in the fourth quarter as the firm struggles to find meaningful deals. At this point, Chairman and CEO Warren Buffett warned an eye-popping performance was unlikely as the conglomerate tries to find deals at attractive valuations. The firm's fourth quarter earnings came in $8.4 billion versus $6.6 from a period before, and certainly still a big pop, but perhaps not. The chances are it happening again, perhaps not likely at this point in time. All right, so we're looking at a couple of milestones in this market, right? So we crossed 3,000 Shanghai Comp. We could get day 10 on some mainland benchmarks. It doesn't look like we'll get there at the open today, although it is early days. As you can see, 2.4%. We did have a cash injection, in fact, out of the PBOC. Let me bring up my terminal and my headlines at this point. When you look at the fix, net injection, 192 billion renminbi open market operation. Same rate on a 7-day, 1.8%. So yeah, there we go. Nothing as far as the fix is concerned, news-wise at least.
Yeah, we're watching very closely some of these analyst actions. To tell you about Lenovo, there was a call there from Fubon with a price target of $10 now, so that's been raised to a buy for that stock. Goldman's taking a look at some of these car services sort of companies in China, raised to a buy for Tuhu Car. That implies a 52% increase from its last price, and Yifan Pharma rated a new buy at CITIC Securities.
Okay, a couple of other things we're tracking here. So, yeah, well, the BYD, we talked about this, and of course them unveiling that fairly expensive bet there in that market, 270,000, in case you missed it a few seconds back here. News in play, XPeng 4.3%. We're also looking at other stocks here. Alibaba, of course, on the back of that story that we just talked about with Lulu on Ant reportedly outbidding Citadel Sec here for the investment banking unit Credit Suisse in China. We're down about 0.3%. Apart from other stocks that we're tracking, Cathay Pacific obviously also very much in focus on the back of two things. You have Singtel reporting that Hong Kong will be rolling out measures to support tourism, and also that Air China is said to be sounding out its advisors on raising its stake in Cathay Pacific. The open 3 minutes away. This is Bloomberg. Good Monday morning. 40 seconds to the opening bell. This world-beating rally in Chinese equity markets. We're now up 15% from the bottom. And certainly the question at this point is whether or not this market is going to reverse as quickly as that sit and stand that people do at buffets where they pretend to sit down at the table and then head to... Is it going to be that quick, or are they going to be in place for much longer than expected.
Yep, certainly we're watching that. Day 10, possibly when it comes to the onshore market, when it comes to CSI 300. We're seeing a little bit on the back foot to kick off your Monday morning when it comes to the Hang Seng as well. But keep in mind, we do have those PMIs to wrap up the week here, so that could be some key data, at least for this week. And take a look at what the markets are doing here right now. So, dollar China's at 720. It was once again a stronger fix in the PBOC. Futures are slightly to the downside here. But yes, 9 days on the CSI 300 is already the longest winning streak since 2018. So that's one to watch very closely. Right now, we're still seeing some red across the board. MSCI China's down about a third of 1%. HS Tech seems to be slightly on offer here this morning. You're seeing a bit of downside when it comes to commodity markets as well, with Shanghai crude as well as iron ore that is slightly lower here. Small caps are doing okay, though. The CSI 2000 is up about half of 1%. CGB's 240 for your Chinese 10-year yield. Let's continue to watch sector by sector. It looks a bit mixed at the get-go here. It looks like industrials, manufacturing stocks are gaining a slight bit here. Developers are slightly on the back foot. Financials are also down about 0.4%. Let's take a look when it comes to some movers as well. We talked about the auto space. So there was some talk from CCTV that there's this consumer push. So maybe we're looking at some of these appliance stocks, auto stocks here today. BYD's up some 3%. The chairman proposing to double its A-share buyback. Certainly the buyback story is a key theme for a lot of Chinese stock investors out there here. Li Auto earnings coming out a little bit later on, as well as, I believe, CLP. And we're watching, of course, Haier and Midea. These are some of the consumer stocks all up here this morning. And we're watching, of course, Cathay as well as Air China. There's a scoop from our Danny Lee and his team of Air China potentially looking at maybe rejigging that stake and raising it when it comes to Cathay Pacific. The stock's up some close to 2% for Cathay here right now, Dave.
Yep. Okay. So let's get a sense now on the sort of outlook, near-term outlook for this market. So in about a week's time, it's the NPC. That's about a week of runway. Beyond that, who knows how far this market can go, assuming, of course, it does move higher over the next week or so. Joining us here on set, Wendy Liu, Chief Asia China Equity Strategist at JP Morgan. Happy Monday. Nice to see you.
Happy Monday to you.
Do I chase this rally?
Selectively, yeah.
Okay.
I do think the index has more to go up. Both the CSI 300 and MSCI China is just below our bearish target. The next thing people will watch, one, earnings, and then two, the twin sessions coming in the first week of March. Any sort of policy signs that people can take away from. I do think in the past 2 quarters, you saw the free cash flow for Asia-listed non-financial companies growing much faster than the CapEx. So the free cash flow. The X growth, but cash flow improvement that is commensurate with the value profile is coming together. Yeah.
Who's buying this rally, you think? I mean, if it's still, you're not seeing the real money, the long-term investors come back, is that going to be something that can markets still stabilize without those long-term investors?
That's a key question. We took a lot of time to look into the flows. Lunar New Year, we saw 392 billion into 730 ETFs, but then 94% of that went into the bigger cap indices, so CSI 300, A50, 500, 1000, and Chinex, right? And then after that, the post Lunar New Year flow, 12 billion broadened out to a little bit more to the smaller caps. And smaller caps, I think on February 5th, you also saw some flows. Now, most interesting is when we look at the EPFR data, the outflow out of China since 3Q23, that was pretty big. It was 18 billion for funds that domiciled offshore, right? But that has moderated. So around that outflow, we saw 11 billion inflows into Japan and 4 billion into India. But since December, there are 4 weeks where we see net inflows into China. So I think there's been an outflow, but it's not moderating. So among the investors we speak to, the EM value people are most interested because they see on a single stock basis, some proxies are becoming quite reasonable in the global EM context.
And is it possible to distinguish what part of those inflows are somewhat state intervention, if you will? across the stock connect? Because there's been talk, obviously, of, I'm sure you've heard about it, right? That state support measures going through the stock connect, and I'm wondering what is coming from state sort of funds, and what are the sort of long-only foreign funds coming back into this market, convinced that there is a floor.
I think people are trying to dig up all the numbers. We don't have all complete numbers, but I think the foreign domiciled fund is a good indicator.
Okay.
So that outflow has moderated, and in some weeks, since December, there are 4 weeks that you see net inflows. I think onshore money, a good part of that is the state, and then people participating accordingly. Yeah.
What do you make of Wu Qing, this new CSRC regulator? He's been working quite swiftly, a bit differently in his approach. He's cracking down on quants, short selling, the like. I mean, do you think that he's doing enough to restore confidence now?
I think, when we look at China, we got 5 cycles. The business cycle, the earnings cycle.
Do you have enough analysts for that?
All you, Wendy.
And then the property cycle, the NPL cycle, and the regulatory rebalancing cycle. So I call this part of the regulatory rebalancing cycle, trying to protect the minority investor a little bit better, build public confidence, and people come back to the market. So I think that's all good, and it's consistent with what we saw with markets like Japan and Korea. Once you improve minority shareholder sort of protection, people come back. But I think it's a process, and I think within that aggregate approach, there's one element that's quite interesting. There are domestic media reporting that restricting fund flows for overcapacity sectors. If that's going to happen, then I think it's good, because for a lot of the high growth sectors, once they're high growing, you get a lot of investment in. ASP comes down, and then stocks have problems on the earnings side, right? So I think that would be something I'll pay some attention to. Back to you, Yvonne.
We were talking to Morgan Stanley, Jonathan Garner, 90 minutes back. So far, essentially, the message from them is they're not convinced that to go overweight in China. Precisely to your point, you talked about India and Japan, because the alternative as far as return on equity, earnings growth, is they can't find a case to be made in China. And I'm wondering what your thoughts are on that.
I think last time when we discussed this, we compared China with topics, right? MSCI with topics. And you get into a period where there's trading, and there's also thematic investing. So we identify 3-4 baskets where people could find good outperformance, like the exporters, the niche leaders, and the domestic incumbents, and then Greater China AI plays. To that very concern, I do think 2 of the 5 cycles, they're still troughing the property cycle and the NPL cycle. But then on property, I think you need a phase of price decline, so there's clearance. And I do think the upgrade demand is there. So by the end of this year, you'll see signs of stabilization in the secondary home prices, and that would be the leading indicator. On the NPL cycle, it depends on how people look at it. There are some investors who say on the FX side that the beginning of the NPL cycle is something that they will take as a positive sign. But we haven't seen much of that yet. And I think in Japan's case, when the NPL started to kick in and then recaps started to kick in, that's when the market started to rally in a very big time.
Okay. So you've switched your strategy, right, from a barbell approach to now something more slightly risk-on.
Yeah.
What does that mean? How do you express that?
Yep. I think with the MSCI being below our bearish target, there's a recalibration. We're starting to see that coming through because positioning have gotten too extreme, valuation too extreme, geopolitical risk probably stabilizing, and then we're going into earnings. And then when we look at the business cycle, it's been recovering, but it's just very weak because pricing is against the volume recovery.
Yeah.
And secondarily, when we look at the sector recovery, on the third quarter numbers, 39% of the 31 MSCI subsectors we track, they're in recovery. It's just that pricing is against them. So if there's any consumer-focused policy that can give us a little bit more inflation rather than, deflationary risk and then net positive real interest rate, then it will also be good. So those are the things we're looking out to. And I think there is support from the earnings. There is support from the policy outlook at this point in time. Yeah.
So if you're correct that this market does rally even further and, some of the cyclical parts of this economy and market rally even further, what happens to the defensive place, like banks, for example, the high dividend protection that investors sort of went into amidst the bear market?
I think there's a divergence in the banks. There's some banks will have much greater NPL risk than the others. So we prefer the leading joint stock bank and then the SOE bank. Now, for this space, there are natural buyers like the insurance companies. They like the high yielders. But I think it's also critical to watch how the NPL cycle will kick in. And that will have more impact on the lower quality tier within this banking ecosystem. Yeah.
All right. Wendy, thank you, Wendy Liu there, our Chief Asia and, JP Morgan's Chief Asia and China Equity Strategist.
Sometimes ours.
Yeah. I like to think Wendy's part of our team. All right, take a look when it comes to markets here. It's pretty slow going here on this Monday morning.
That's
CSI
Monday.
300, Shanghai Comp flat right now, but keep in mind, if we get a 10th day of gains in the CSI 300, that would be the longest winning rally we've seen since 2014 right now. Plenty more ahead. This is Bloomberg.
Okay, welcome back to the show. As we're looking into some of the big tech names across the region, hardware, semiconductors to be more specific, SMIC, TSMC. There you go, 10th of 1%, and Samsung, nothing much as far as.
You missed out last week, really. That was really the only game in town. NVIDIA.
Oh, yeah.
And these stocks were just going nuts.
Yeah, I was trapped in the jungle, yet I still had one eye on NVIDIA. Suffice to say, it's a circus out there.
We got to ask about chips, though, right?
Why not?
If you take a look at these global tech supply chains are set to shift and diversify in response to geopolitical tensions and the pandemic. That is according to our latest report from our very own Bloomberg Intelligence. Let's bring in our Asia tech analyst, Charles Shum. Charles, I mean, you're seeing this projected shift, right? That you think that, where you're starting to see chip making and leading edge chip making heading towards the U.S. and Europe. How do you think that's going to change the competitive landscape globally?
Yeah, thank you, Yvonne. Actually, we just do a report this morning. In the report, actually, we have studied the whole project pipeline that's been released so far, and our conclusion is that actually it's very likely that for the leading edge node, that's 5 nanometer nodes or smaller, actually it's very likely that right now the Taiwan's market share is 61%, but by the end of 2032, we think that it's very good chance that the U.S. and Europe, their combined market share, they can actually go to 43%. That's actually equivalent to Taiwan's market share. So that's one of the conclusions we have from that report. Yes.
What are the things that stand in the way, challenges that the U.S. and Europe might have to get to? Was it 43%?
Yes. And actually, when we look into these projects, we think that most of them actually is being pushed by the government incentive. Actually, for example, government incentive is quite important because we believe that actually even just about the construction cost, 25% of that is sponsored by the government. Actually, that can cut back the payback period at least by 1 year. So that's one factor. And that's so if a government subsidy cannot be distributed on time, actually that could cause some problem. But on the other hand, actually, you have to understand that we are not talking about just building 2 or 3 fabs in Europe and US. We are talking about at least 10 to 15 fabs in each region by the next 10 years. So that means let's do a calculation here. Actually, each fab will require about 1,500 skilled workers. So that means at least 30,000 engineers they need. So that's actually a big problem that could be for them if they want to put them in a full capacity operation. The talent is the problem. Yes.
What about when it comes to China? I mean, you're saying potentially China commands a significant portion of the world's chip making based on mature technology nodes, right?
Yes.
What implications would that have for the chip market?
All right. Yes, that's a very good question. Actually, although China is under a very strict U.S. sanction right now, we're seeing that actually they are changing their strategy, not focusing on the leading edge. They are focusing on a mature node that's mostly for the production of those power chips in EV, and also for our home appliances and also IoT stuff. Actually, for example, the SMIC, they are expand very aggressively. They actually adding one fab each year, so that's actually give them a presence still a strong presence in the whole supply chain. Also, you have to consider that right now the U.S. and Europe, they are focusing on the leading edge nodes, and the mature node actually is going to be dominated by the China. They actually will have the capacity more than 35% by the end of this year. So that's the thing.
Okay. Fairly comprehensive for our clients, of course. You know where to find the research there out of Charles Schrum and the team, Bloomberg Intelligence analyst there. Okay, let's talk us through. Well, let's talk about trade, talk about wine. Why not? It's 9:47 a.m. on a Monday morning. Someone's out there having it for sure. Australia is seeking to end tariffs, I think China wine tariffs, that is to be more specific here, which were imposed actually after Canberra sought an investigation into origins of COVID. Australian Trade Minister Don Farrell is expected to discuss the matter with his Chinese counterpart at the upcoming WTO meeting in Abu Dhabi. Paul Allen explains what's at stake.
It's been a challenging few years for Australian winemakers. When China slapped tariffs of up to 200% on Aussie wines in 2020, it left the industry scrambling to find new markets.
We lost everything overnight. We had built a business in China.
When Australia called for an international investigation into the origins of COVID-19, China responded with a range of trade strikes against Australian products. The relationship has since thawed. Barriers against barley, coal and other exports are now gone, and wine is expected to be next. Australia suspended its appeal at the World Trade Organization over the wine tariffs when China announced a 5-month review. That review ends on March 31st. Australia's Trade Minister will meet his Chinese counterpart on the sidelines of the WTO meeting in Abu Dhabi.
We want the tariffs on Australian wine removed, and if we don't get that, then we'll resume the WTO application ASAP. Our agreement to suspend the WTO process was based on the successful removal of all of the tariffs.
Shares in Australia's largest listed winemaker, Treasury Wine Estates, have slowly recovered since China imposed the tariffs in November 2020. In this month's earnings announcement, Treasury also signalled it's expecting something to celebrate soon.
The review of tariffs on Australian wine remains ongoing, with a determination anticipated in late March. We are prepared and we're well placed to re-establish ourselves and our Australian portfolio in China should the review result in the removal of these tariffs.
But there's a question about what Australia's exporters have learned from the whole experience when it comes to reliance on China. Take barley, for example. China went from buying almost all of Australia's barley to buying none at all during the diplomatic deep freeze, forcing exporters to diversify and find new markets. Since tariffs were lifted, Australia's barley producers have gone straight back to their most lucrative buyer, with China accounting for 90% of exports in December. And of course, when wine begins to flow, memories can become hazy. Paul Allen, Bloomberg.
All right, that was Paul Allen there. Of course, as you take a sip of that wine, take a look at these markets here. Not seeing a whole lot of juice right now. CSI 300, we are down about 0.1%, just below that 3,500 level there. This is Bloomberg. You're watching Bloomberg Markets China Open, and look at some of the stories making headlines when it comes to local media in China here today. And the China Securities Journal is reporting on the impact of the CSRC's tightened rules when it comes to IPO approvals. It says 44 companies have withdrawn their applications as of Sunday, and that the pace of issuance and the amount of funds raised have declined. Also on the front page of the paper, an upbeat note when it comes to earnings. 40% of nearly 3,000 A-share companies that have disclosed annual results, providing some positive guidance out there, and the report does say that auto manufacturing, biomedicine companies saw big improvements in their numbers.
Although, if you ask Morgan Stanley, they'd probably take, I guess, some consideration as far as that's concerned.
Yeah.
So they don't so far believe. Almost 3,000, you could make that argument for the Shanghai comp, though. We're almost at that level. If not there, just below maybe. Now, this is on social media, on Weibo here. China's space ambitions are a hot topic of late here. Lots of excited posts here about the space agency unveiling now. We now have the names of the new manned spaceship and a moon lander. So the spaceship is actually called Mengzhou, which means dream vessel, and of course the moon lander is Lanyue, meaning embracing the Yue, the moon. So there we go. I guess a better way to describe it. Okay, also taking place, and certainly some sad news over the weekend, Sunday morning, local time, Zhong Qinghe of the Wahaha Group, news came in that he passed away. He died at the age of 79. He became China's richest man by wresting control of the country's top beverage brand from Danone. This was about 15 or plus years back. Chinese netizens are calling the self-made billionaire an outstanding and patriotic businessman who certainly worked hard with passion. He was certainly very old school. He was from, I think, Zhengzhou, which is the cradle of private enterprise. And
humble beginnings.
Humble beginnings.
And he lived a very frugal life, right? They said he always flew economy class, second class on trains. He says he only spends like less than 50,000 renminbi a year. Doesn't travel with an assistant. And really, a guy that people say was a guy from the past, right? That really encapsulated the entrepreneurship, the animal spirits of China at that time.
The reopening, I mean, this is the OG consumer play, right? One of the first generation of private businessmen, of course, there after the economy reopened there, and certainly the win with Danone certainly put him certainly into focus. Anyway, there we go. Zhong Qinghe was 79. Okay, just very, very briefly, a couple of other stocks that we're tracking here at the open. 24 minutes into the open here, we're looking at, well, internet consumer stocks on the back of this push into consumers. As you can see, a rally still for many of these names. We're looking at Cathay Pacific up 3.3% on perhaps reports and news here that Air China might be mulling increasing its stake in the airline.